Hey guys, Stockaholics, thanks for being here today. Let's talk tankers. It's been a while, but I think it's time. In this video, we're going to talk about rates. We're going to talk about some divergences that's going on between different classes. We'll take a look at some inventories. We'll talk about SPR releases and some OPEC cuts, among a bunch of other things. Okay, here we go. All right, the first chart we are looking at is the Baltic Dirty Tanker Index. The Dirty Tanker Index had a peak in November of last year. Going into April, it had a sharp drop and bottomed. And recently, in the last couple weeks or so, we've seen a rebound in terms of the Dirty Tanker rates. I want to make a quick point on the Baltic Dirty Tanker Index. To my knowledge, this index is skewed more towards smaller vessels, so your vessels like your Aframaxes and your Suezmaxes, and less towards your VLCCs. There has been a divergence in rates between the VLCCs and the smaller vessels. I'll show you guys that a little bit clearer in a second. But first, we're also going to take a look at the Baltic Clean Tanker Index. The Baltic Clean Tanker Index saw all-time highs in December of last year, going into the embargo on all Russian products in most European states. That's collapsed, however, going similarly to the BDTI in the new year. They had a strong rebound in March. However, there has not been a rebound in rates in the clean tankers, and we are towards those bottom ranges of the the index for the clean tankers. Now, quick point, the divergence between these two indexes is unusual, and it is unlikely to be sustained, in my opinion, simply because vessels between one segment are likely to switch into the other if they are able to take advantage of that arbitrage between the clean and the dirty. Yeah? So at some point, I would expect either, unless there's a sharp rebound in terms of product tanker demand on its own, but it's likely that at some point you're going to see a rebound in my opinion, in the clean tanker index, or a decline in the Baltic dirty tanker index, or some combination of those two things. Now, this is a post from E. Finley Richardson on Twitter, who you should be following if you are not. I'll put a link to his profile. He posts all kinds of things related to tankers and shipping in general. Now, I wanted to show you guys this chart. This is from Clarkson's. And just to show you the divergence between these classes in the crude segment in particular. The red line here is the VLCCs. Those are your largest vessels, and they've generally been underperforming the smaller vessels. And that really doesn't make a lot of sense, because you can hold twice as much crude in a VLCC as you can in a Suezmax. So it would be logical that they would be able to earn more. But just the way that these trade flows are panning out, the exports from Russia, it's harder for these VLCCs to kind of cannibalize, to move into that trade, it seems like. And there are things like ship-to-ship transfers where the VLCCs are getting some business, but generally it's been a two-tiered market, and the smaller tankers have been outperforming. And again, because the Baltic Dirty Tanker Index is skewed more towards those smaller vessels, that can explain that uptick recently on the index, whereas VLCC rates have continued to come down. However, I do also want to make a point. The Vs also seem like they could be forming a bottom here, like the sentiment, and I've seen some, I don't know, some fixtures that look a lot more positive over the last week or so. So I would expect, well, I wouldn't expect anything, but it's possible that the red line will start moving up in the coming weeks and months. Now, I want to make a point on seasonality. This is the pattern that we have seen so far, even though the catalyst to this market is very clearly the Russian invasion, and more specifically, the embargo on Russian oil and refined products into Europe. There has still been some degree of seasonality that we could clearly notice in the indexes. And so it's not uncommon for rates to fall off, or to peak in around November, December, and then to fall off into the new year. There's a number of reasons for that. The demand for your things like your heating oils and things like that are higher in the winter months. You also go through things like on the product side where you have refinery maintenance in the spring and autumn, I believe. So I would expect, well, again, I'm not going to expect anything, but it is highly probable that you'll see some kind of a rebound in both segments going into June and following some kind of a pattern like this. Okay, to kind of explain what's going on with product tankers and why have they come off so much in relation to your crude tankers. This is probably one of the biggest reasons, and I think that your European Union has driven a lot of the marginal ton-mile demand, pushing your product tankers to extremely high utilization rates last year. And that's because they implemented an embargo on Russian products. However, in February 5th of this year, however, leading up to that, they kind of supercharged the demand for product tankers. They did that because they were worried probably about what would happen post their embargo when they could no longer import Russian products. So they built up a lot of inventories, nearly twice what they had last year. However, like Ardmore is saying in the slide, those inventories have started to build. And as those inventories drain, it is likely that you will see further demand in product tankers and likely to lift rates sometime within the rest of this year as these inventories draw. Right now, I think they're drawing at about 1 million barrels a month. So it may take a few months to get down to these lower levels, but well, they may also decide that, hey, it's a security issue. We might want to maintain these inventories. I don't know, but we'll see. This does, however, explain some of the weakness in the product tanker rates, simply because, again, they don't have as much demand for those imports. I do want to show you guys, though, this is a chart of imports of crude oil and petroleum products into Europe all over last year. And that has slowly been declining all year. That blue line here is Russia. And they have very low imports. And then it's hard to see with all these these colorful lines here, but in general, these lines have been trending up, likely adding to some ton-mile demand for your clean tankers. Here's another chart, kind of more clearly illustrates that the Russian crude oil and refined products exports into Europe. In 2022, there was about 4 million barrels a day, and then now at February of this year, that has been cut in a fourth. So although you can't see that there is going to be necessary demand for these product tankers into Europe right now, and because those rates are so low, at some point in the future when those inventories draw, it is likely to again push up those utilization for those clean tankers. This is a excerpt from an article, kind of elaborates a little bit on what I was just talking about via Hellenic Shipping News Worldwide. Their title of that article is called European Tanker Owners Make a Fortune Off of the Russian Trade. When the EU diesel inventories wind down. EU diesel imports could drive the next move in the tanker markets. The EU prepared for the ban on Russian diesel imports last year by bringing volumes forward. It loaded up inventories over the second half of last year, and this has led to a downturn in imports more recently. The EU clean product imports averaged 2.7 million barrels per day in March, down 1.1 million barrels per day, or 29% from October, according to Kepler. The EU is not receiving nearly as much diesel as it normally would because such large inventories were accumulated. At the moment, the EU can afford to work its way through these inventories. When there's not enough left, EU importers will need to bring in diesel cargo from non-Russian origins in volumes we have not seen before. We have seen that the Indians have been taking in a lot of Russian crude volumes below the price cap for the most part. I think there was recently they may have been importing some when Russian oil had recently gone above $60. But anyway, for the most part, they have been refining a lot of that and also sending a lot of that crude or that refined products back into Europe as well. So there's some ton-mile gains in areas like that. This means from Middle East, India, and potentially China. And when that happens, we would expect the top tier of these two-tiered market, the non-Russian tier, to get much more expensive. And it will potentially also mean that clean product freight becomes more expensive. Now, I wanted to give some other points of view on the product tanker market out there. This is an excerpt from an article by Mackay Marine. I'll post a link to the article and his Twitter account somewhere below if you are interested. And he writes in his article that there are trade efficiencies basically being added to the product tanker market. So although there was that initial spike in ton-mile demand for European products and things like that, there are a lot of efficiencies happening in the market over time that really don't get a lot of light in other sources. So basically what he's arguing in this article, I'll read this first of all. As we have suggested for months, the brokers are conveniently forgetting the offsetting flow. So although there is that first layer impact in these flows of Russian products into Europe on short haul voyages, there is secondary, and those going much further abroad, there is secondary impacts as a result of those imports going into other places. As it turns out, Primor Santos is less than Sika Santos, 8,000 nautical miles, to Jubail Santos, 8,436, and Singapore Santos, 9,003 nautical miles. So basically, these Russian imports, a lot of those have been ending up in Brazil. And although there is potentially some ton-mile demand gain on those exports in relation to the U.S. Gulf, about 1,000 nautical miles, there are already some very long-haul imports into Brazil from these much further away places that are now going on actually shorter haul routes as they are being exported from the European Union, right? Now, this doesn't take into account the other side of that too, because now that the Europeans aren't getting that from Russia, they have to get it from somewhere else. So there might still be a potential ton-mile gain from that, especially as those, recently we've seen a lot of those coming from places like India, right? This voyage is longer than Houston Santos. However, the net impact hinges on the amount of U.S. diesel displaced versus Pacific Basin sources. I think he basically is arguing that there is ton-mile gains in the product segment. It is just nearly not as much as a lot of sources and these companies out there would have you believe at present anyway. Okay, we talked about the product tankers quite a bit, but I wanted to show you guys a few things talking about the crude side of things. This is one of the reasons I think that the VLCCs had done so well, despite them not really being able to be benefiting so much from the Russian war as some of those smaller vessels have. This is a chart from HFI Research, and I just wanted to show you guys the SPR in the US, right? So this first circle here shows you that over the last year, there had basically been about 1 million barrels a day of SPR being released in the United States. And that really matches almost barrel for barrel what you see in terms of oil on water, in terms of that crude oil. I'm not saying there's a perfect relationship here because we do know that there is a lot of ton-mile gain in those smaller vessels. But I would imagine that a lot of the reason that we have seen such strong VLCC rates over the last year would have been some impact. This would have been some impact, right? And those that the SPR has effectively come to an end for the most part in terms of their barrel releases. The Energy Department, I guess, I'm not sure who, I think that's what they're called, who are in charge of the SPR. They have recently said that they're going to be coming back to the market. I know there's been a lot of skepticism on whether they're actually going to follow through in filling the SPR. It's a very small amount that they've agreed to, like 3 million barrels. You know, that's like basically 1% of what they've released. But any amount that they fill it is going to have potentially some benefit on the tanker rates. Now, I will say this, that I think that the SPR does have to be filled with local oil in terms of, and they specifically want sour oil recently. if it is being filled locally, that it is still likely that you're going to need some oil coming from somewhere else to make up for those flows that are kind of used locally. And that might not be a one-to-one relationship, but I'd still, even though we are filling SPR locally, I still think that it would likely have some small positive impact on tankers. Okay, the crude tanker rates, especially your bigger ones. And although it might be a popular opinion, I would still expect there to be more SBR purchases going into the future, just not nearly at the rates. They're not going to be filled at nearly the rates that they were being released into the market. Okay, now we're going to talk a little bit about OPEC, right? Recently, there has been a cut of by OPEC. OPEC Plus Alliance on April 2nd announced voluntary cuts to their production, about 1 million barrels a day. So most of these are coming from the Middle East. And Russia also said prior to this cut that they were going to be cutting as well. I'll get into Russia a little bit more in a second. There's a lot of reason to believe that they are not actually going to be cutting, but again, we'll get into that. Um, Most of these cuts come from the Middle East, right? And so you could see as soon as that happened, the VLCC rates kind of just the floor came out under them, and the sentiment in that segment, just the owners were just like yielding to the charterers right away. Most of this again comes from the Middle East, and a lot of that goes to China. Now, I will say this, even though there's a lot of cuts, China's demand doesn't suddenly go away. So it begs the question, although there is less supply on the market and that is bearish, what are the secondary effects of this oil not being available, and especially to China, right? They could be purchasing from farther away ton mile gains, like places like the US Gulf, and also from Brazil. And we've seen a lot of that, right? And again, I want to point out that this is the seasonally weaker time of the year. There's also a bunch of counterpoints out there in relation to these cuts. You know, does does OPEC really have the spare capacity anyway as they're going into the summer months? A lot of these countries have their own internal oil demand, especially as it gets hot in a lot of these places for their own energy needs, right? So a lot of moving parts, and we'll see on this. Okay. Okay, now on to Russia. Russia has said in February of this year that they were going to be cutting as well. They actually announced prior to, I think, the OPEC cuts. However, since then, it has become reasonably apparent that they may not be cutting as promised. And there could be a bunch of different reasons for that, why that may be. But first of all, we'll get into this article. This is from oilprice.com. And the article is titled "The IEA Says Russia Isn't Cutting." In February, Russia said it would cut its oil production 500,000 barrels per day. Again, that hasn't been noticeable in terms of their exports. The IEA says that Russia hasn't cut its oil production and may even be looking to boost output, and their export revenues are estimated to have increased by 1.7 billion month on month in April, but we're down by 27% compared to a year ago. Their oil revenues have actually, compared to 2022, have actually gone down quite a bit, even though they've been exporting as much as before, if not more. And that is, part of that could be because of the oil prices themselves coming down. It could also be because they've lost a significant customer in terms of their natural gas exports. But it also could be that the price cap might actually be having some effect on Russia as well. With as few customers as there are for Russian oil, the customers that they do have been taking advantage of that and demanding price cuts as well. So all of these reasons, the Russians' tax revenues in terms of their energy exports has been suffering over the last year. Okay, even though they've had higher than normal exports in terms of oil. and refined products. Russia has failed so far to cut its oil production by 500,000 barrels per day as promised, and it may even be looking to boost output to compensate for lost revenues, the IEA said on Tuesday. Russian crude oil and oil product exports continue to prove resilient, with exports hitting in April the highest level since the invasion of Ukraine. At 8.3 million barrels per day. And this is probably one of the reasons why there's so much support in those smaller vessel classes. The IEA said in its closely watched oil market report. The record exports contrast with expectations that Russia would lower supply to the market now that it has promised to cut output until the end of the year. One of the main reasons why the oil price spiked so much last year to above $100 a barrel is there was this view that the Russians would have very hard time maintaining their oil flows without Western aid in their service sector, in their oil service sector. So far, that has not been proven to be the case, but we've seen before over really long periods of time when you don't have you're under a sanctions regime, these kind of things do have an effect on your oil production, but it just doesn't have that kind of effect in the short term. So my opinion, I think that these sanctions and this war and all of this stuff that's going on in Russia is likely to affect Russia's ability to produce oil in the long term, but in the short term, it's just not having a profound effect, right? Okay, Russia warned in February that it would cut its crude oil production by 500,000 barrels per day due to EU imports bans and the price caps. Initially, Russia said this lowered production would apply to March, but Deputy Prime Minister Alexander Novak announced partway through March that the cuts would be extended until the end of 2023. Now, I think the context matters a lot too here. This is my opinion again. I think that Russia needs revenues now, right? They're in a existential conflict in their view in the Ukraine, and they need revenues to support their war, right? And what that means is that they really can't, in my opinion, cut, because if they cut, they risk that revenue again in the short term. What if you cut and oil prices, don't go up to compensate for that or overcompensate for that, right? So really I might be a conspiracy theorist on this one. You guys can let me know. I think that the Russian strategy here is to lie on these cuts, say you're going to cut and, go lockstep with the OPEC cuts, who are actually cutting, by the way, and take advantage of that and export as much as you can and basically front load, kind of like the Europeans front loaded their own imports. The Russians are front loading their exports to kind of get as much revenue as they can for their war in the short term. And so, in my opinion, I really don't expect cuts from Russia unless they are just literally physically unable to keep up those flows. By our estimates, Moscow did not deliver its announced 500,000 barrel per day supply cut. Indeed, Russia may be boosting volumes to make up for lost revenue. And again, we've also mentioned, second order effects, right? I might be a conspiracy theorist on this one, but I think that there is really a non-zero chance that OPEC is not happy with this. But how does OPEC respond if Russia is saying that they're going to be cutting, but they're not? And, if they're actually increasing their exports while OPEC is cutting, how did the individual member states respond to that? How do they feel about that? And although I don't think that they've really formally agreed, this is kind of just voluntary cuts. Again, the OPEC has, this is not, I don't know if this is widely known either, but OPEC has a history of breaking down. It was only a couple of their cooperation. It's only a couple of years ago, I think people already forget, where they had a price war, where the OPEC was flooding oil onto the market, right, along with Russia into the COVID shenanigans. But anyway, well, that's a ton of love. There's a lot of moving parts, a lot of hypothesizing here. But I would not expect that Russian crude oil flows shrink, at the very least. Okay, this is a slide from the INSW, International Seaways. I like this slide. It kind of succinctly summarizes kind of what's going on with demand. Oil demand is expected to grow by about 2 million barrels this year. So that's a big, finally talking about demand growth in oil, which has been kind of against the trend for the last couple of years with that virus. It's averaging at 101.5 million barrels per day, ramping up, especially in the second half. There's a lot. I've also seen this from OPEC and the IEA. They expect second half to be much stronger than where we are now. The macro conditions remain mixed. I would agree with that. I've made some videos on this before. I think one of the drivers in terms of incremental and accelerated demand growth for commodities in general is driven largely by U.S. credit expansion. And we've seen some weakness in the U.S. I wouldn't say that it is negative, and I wouldn't say that it is recessionary like a lot of other people believe, but it is definitely not extremely positive either. So I agree with that statement that it is mixed. I might make a video on that. Let me know if you're interested. Oil demand growth is largely driven by China, which is expected to increase by 0.8 million barrels per day. And a lot of that is likely to be coming from jet fuel demand. They've been locked down for the last several years. I can almost use that word, several. And so there's very likely to be some sort of revenge travel. Actually, I think I have a slide over here. Yeah. So this is taken from Flight Radar. This is the number of commercial flights tracked by Flight Radar. This black line is 2023, and this purple line, magenta, is 2019. So we've finally surpassed the flights that we've seen in 2019. I've seen some other people say that there's probably some efficiency gains in the airline fleet. There's been a lot of new planes added since the pandemic. But overall, the jet fuel demand is highly likely to be going up this year. And I would expect some revenge travel, much like we've seen in the West, coming from the East as they are emerging from these lockdowns. It's been slow. It's been a long grind. It's been a long time coming, but it's definitely finally here. They mentioned that in this slide that OECD inventories have built. That's going to take some time to build through. As that starts to draw, I would expect that tanker demand comes back. OECD SBR is approximately 26 days of forward demand. I'm not sure what that means. And refinery margin, I've seen this in a lot of places. A lot of people are talking about refinery margins under pressure. Refinery margins, if I don't have a chart on this, but if you look at them, they would have gone to the moon, and like they've recently basically touched our atmosphere in terms of refinery margins, right? So in terms of these guys going and exporting products, those margins are still very, very good for these guys. And because they have earned so much money, this is my opinion here, because they've earned so much money, like in my opinion, I don't think that they're going to suddenly, even if they started to come to break even levels, I really don't think that they're going to stop producing product in meaningful levels, right? They've earned so much money. Now is the time for these guys to really be fighting for market share and pumping out that supply. So this is a common theme I see everywhere. I'm not the foremost expert on this, but I just don't see why these guys are going to start suddenly, as those have gone down a little bit, why they're going to suddenly stop producing as much as they have been. And there's a significant amount of supply coming online in terms of refinery over the rest of this year and next year, and I think the year after that. So I'm definitely not bearish on product getting out there onto the market, right? There is so much more that I can talk about in the tanker market, but I feel like this video is getting really long. I may make another video in the near future if people are still interested in this kind of stuff. Let me know in the comments below. If you like this video, give it a like. And there is also a thanks button. If you are interested, please consider donating to this channel. It would be greatly appreciated and may motivate me to make more videos. I'll see you guys soon. Take it easy.